He's the CEO of RBC, and he's with us now. Dave, thanks for being with us.
Good afternoon, Amanda. How are you doing?
Well, I'm doing well. And I want to start with, we knew that the set-asides for bad loans would be big, and it's prudent that they're big. But just walk through the thinking on how you determine when a performing loan should be flagged and there should be a provision against that loan, because there's a fair amount of that going on in this quarter. So just give us the bank's thinking on how much of that should happen.
Yeah, if you're asking about the process, it depends on the borrower and the clients. At the high end of the market, at the corporate end, we go through that portfolio name by name, sector by sector, and we apply judgment on a performing loan to say, are you in a challenge sector? What's the resilience of your capital base, your sources of funding? So we go through every single name in our portfolio, whether it's energy, retail, hospitality, airlines at the upper end of the market. As you move through the commercial, we do something similar. But as you get into, as you can imagine, millions of consumers and hundreds of thousands of small businesses and commercial businesses, we apply more of a top-down sectoral approach to it. So we don't have the ability to go through every single name, but we apply judgment to a sector, to individual subsectors, and we come up with an estimate of potential future losses at the portfolio level. So it's really a combination of a top-down and a rigorous bottom-up process using judgment around loans. And what's new about this, we do this all the time. We do this every quarter normally. What's different this time is that we have to apply the impact and mitigation impact of all the policy relief, whether it's the CEBA relief, the wage subsidy program, obviously the CERB programs. They come in, they overlay support to our borrowers, in addition to the substantial payment relief that we've granted to our clients. All that comes in to mitigate a short-term loss.
So and I'll take this in pieces here just so that we can kind of break it down, but we know mortgage deferrals have been a fairly big piece of the puzzle here. From the bank's point of view, and again, I guess we should stress, and maybe you can give us your thinking on this, there is no precedent here. So I don't know how your number crunchers and your computer programs manage something for which there's no kind of previous input. There must be a bit of alchemy there. But when you're looking at, say, a deferred mortgage, some of those will default, right? For some consumers, deferring is putting off a debt, but even the additional interest that will accrue and have to be paid later will put them over the edge. Is it fairly easy to calculate which of these mortgages are close to the line? So we know the loan loss provisions are actually a reflection of what's still ahead.
We have a very good handle of how our customers are faring. Obviously, we have risk management systems, we have monitoring systems, we talk to our clients all the time. While a number of clients have deferred their payments, it didn't mean they deferred all 6 months of payments. They may have only deferred 1 month. Some did it proactively just to create a cushion to potential uncertainty. So there's a number of reasons why a customer makes a deferral. So I wouldn't assume it's always the worst case. They've lost their job, they can't make the payments, and they've deferred all 6 months. There's a range of deferrals. So I think from that perspective, we do monitor and talk to our clients. There will be some clients after 6 months where they are not back to work and they don't have the reserves. We'll sit down with each one of those clients, work proactively with them, whether it's continuing to defer or where is the source of income going to come from. So we'll treat every client on a case-by-case basis, from the smallest consumer client to the largest corporate. So we have processes and capabilities in place to do that. So I think it's a range of potential issues. And I think you saw the large provisions this quarter against these portfolios, particularly in commercial and capital markets, because of the uncertainty of the economic outcomes, driven by the uncertainty of the health outcomes that are coming at us. We're going to see volatility in health outcomes, just like we saw in New Brunswick over the past couple of days, where we thought we were clean in a certain area, we had a contagion risk. You're going to see that across a number of areas, and the conservatism and the prudence that we apply to reserving and our portfolio reflects the uncertainty going forward, and that conservatism was warranted.
Can we refer to this level of loan loss provisions as a high point? I mean, will it get better from here? Can we say that?
We think we've been very conservative up front, taking a $2.2 billion charge against performing loans. It takes our ACLs, we call it a reserve for loan losses, up to $6 billion, which is 3.5 times coverage of kind of the trailing 4-quarter loss rate. So we view that to be a very conservative level of $6 billion. Our expectation is that, yes, this is the high mark. for our stage 1 and 2 charges, and therefore we should be able to start drawing down on that reserve ratio to offset future non-performing loans. So I think that's absolutely why we took the charge up front. We recognize the uncertainty, and that conservatism should allow us to manage the ACL back.
And in that conservatism and the stress tests internally that you run, what does the worst case scenario look like? Are you factoring in a second wave? Are you factoring in a very protracted recession? I mean, does all of that go in the mix into that conservative number?
You can imagine we run a whole scenario of stress tests, from what we think is severe in our base case to extreme, where we have upwards of a year plus. Our own forecasts take us out to probably another year and a half or 2 years before we're back to GDP levels that we saw pre-COVID. So in planning for these scenarios, potentially a slower recovery, particularly in the discretionary consumer economy, which has been the hardest hit. In Canada, the discretionary consumer economy is roughly 20%, and that was down almost 75% in the month of April. It's come back now. About half of that's recovered. We look at our credit card portfolio, it was down a record, and purchase volume was down a record 35% in the month of purchase volume in the month of April. It's down roughly 19% in the month of May. So you're starting to see that recovery. It's the early shape of a V, but we don't expect the remainder of that to be in a V-shaped recovery, a more prolonged kind of 12 to 24 month recovery of the discretionary and non-discretionary part of the Canadian economy. So that's slow. We factor that in, and a potential delay and slowness to that, and we put that into our models, as you said, from a bottom-up and a top-down perspective. And that gives us outcomes that makes us comfortable that in all those scenarios, we are above our regulatory minimums. And therefore, as we signal to the market in our analyst call on Wednesday, that under the scenarios that we're running today, even in our toughest scenarios, we are above our regulatory minimums, and therefore investors should feel comfortable in our capital levels, which are starting at a very strong level, only came up 30 basis points in the quarter. With all the drawdowns that we saw, with all the reserving, we went from 12 to 11.7%. That $15 billion cushion that we enjoy over our regulatory minimums gives us confidence that we will not need, under the scenarios that we're running, to raise equity during this crisis.